Hello everyone and welcome to the Outspoken Market. Leandro Guerra speaking. If you know the RSI indicator, I'm pretty sure you have been using it wrong, not in the way that its mathematical formula suggests. And here is the proposal from the paper I just wrote, revisiting the relative strength index from an oscillator to trend following indicator. Yes, that is true. Traders, they think the RSI is going to be something to point out overbought or oversold zones from a particular security, and that it's not the case. And in my paper, I point out to you every single reason that you should trust, verify, and actually trade by the trend following point of view. Before we go into any charts or explanations, I want to show you something. Think together, think with me about something. Now, if we are speaking about the RSI, we usually say that if it's above 70, the stock is oversold, and if it's below 30, it's overbought. But let's take a look on the RSI's formula. So it's 100 minus 100 over 1 plus RS, on which RS, that is the relative strength, it's the average gain divided by the average loss. And this is the key point. So this is what drives the indicator. The other components, they are just to make it float between 0 and 100. But if we take a closer look on that guy, from here, from that very simple formula, you understand what I said in the beginning of the class, that this is not an oscillator. This is a trend following indicator. And why is that? Let's say we take the standard period for the RSI, that is 14. It doesn't matter the time frame. Let's stick with this baseline. Now, do you agree with me if the past 14 periods, the average gain is equal to the average loss, that particular ratio is going to be 1, correct? And if the RS is 1, it means that here we have 1 plus 1, of course, it's 2. 100 divided by 2 is 50. And then, therefore, the RSI becomes 50. So this is the middle line. Now, if the average gain goes above the average loss, is bigger than that, do you agree with me that the RSI is also going to be higher than 50? And if the average loss is higher than the average gains, the RSI will fall below 50. And this is like a train going into the rails. Once you have the average gain with momentum and in the opposite side, the average loss gaining momentum, that train is going to keep it up on its rail until something else happens. It's like the inertia law. It's like the principles from Newton, from the physics, applied to a very simple concept, of course, here in the market. So when you reach the level of 70, on which people classify something as overbought just because it's above that level, it makes no sense at all, because the average gain can keep it up, can keep going up, and there is nothing saying that this, because that number has been reached, something is going to happen. However, we know that the average gains are above the average loss, and that's why the indicator is being up. And the opposite, it's also true. So just by reasoning a little bit, with very little logical thinking, looking at the way the indicator is built, you can already infer that yes, that's right, we have been using it wrong. This is only about trend following and it's not about an oscillator. That is so true that if you pick up any chart of any security and take a look on the RSI, you are going to see what I'm saying. And you know, I'm not a chartist. I don't believe, but it's not a fact that I don't believe, because believing it's a matter of fate. There are no evidences that chart analysis makes you make some money. Not even technical analysis on itself. So you must have a quantitative approach. However, to point out my case, because it's quite simple to illustrate something visually, I want to show you some examples. However, by having a quantitative approach, my recommendation is that you transform that into attributes that are going to compound a model, a system that is then being entirely quantitative. And it does not need to be sophisticated. Remember, simplicity works. Let's prove my point then with just a few analyses over here. This is the S&P 500, and we have the RSI, and the purple line is the RSI as we know it, and the yellow line, it's the low pass filter of the RSI, as known as moving average. 5 days only, more than enough, just for smoothing the noise from the RSI signal. If we take a look, there will be countless times on which we achieved the overbought and oversold zones, or we have divergences and nothing that was expected has happened. However, again, countless time when we go above the 50 level, like we had over here, then the stock or the security went up and it kept it up. And when it went down, it also went down over here. And I could go on and on then all day long on that. Of course, nothing is perfect. There will be some, let's say, false positives in that particular case, but they are going to be small. It's unlikely, or better saying, you have a low probability of having a large loss. And of course, to protect yourself, you can use a kind of stop loss set up in the way that you prefer. But if you pick up any time frame at any stock or security, you are going to see that trading the RSI as a trend follower indicator, it's actually the right way. And of course, because it is the right way, it's way better than the other approach. And this is what I prove in my research paper. So you're going to find some literature review pointing out there has been in the past a few papers also talking about the effectiveness of the RSI as a trend follower, and they are here for you to take a look on them. And we explained through the methodology the main points that I was highlighting in terms of the formula, just everything that we saw when I was trying. Then in the empirical approach, we do several tests with different time frames, with different securities from the S&P 500, some forex like the Euro, USD, gold, Bitcoin, and in each one of them, regardless the time frame, we have precisely the very same result. By the way, if you are also up to coding, which I strongly recommend you to be and to do, all the codes that generate this analysis and these charts and everything, they are available on my GitHub account from the Outspoken Market, and the link is here down in the first comment. But for example, if we take a look in the S&P 500, we are just gonna see what we had there in the trading view. Now, if we go, for example, to the forex Euro USD, this is 1 hour data, exactly the same pattern it's going to repeat. If you go to the Bitcoin in the daily data, or if you go to whatever asset, you're going to be the same thing. Not only, I'm also show you some tables with the distributions of the regimes, also the mean forward returns based on what happens after, I don't know if we have reached the levels that are quite well known. How was the average return for that particular security 1 day after, 5 days after, 10 days after? I mean, it's everything extremely complete and with the proofs about what we have been claiming over here. So it's not a long paper. I strongly recommend you to take a read. If you have any comments and considerations, you know where to find me. I'm more than open to receive any kind of feedbacks. My students, they are already, having that particular approach being applied. They are sending to me their results and they are great. So let's think in a more effective way, looking at the markets with a quantitative approach, understanding what it's behind it, and you see, I mean, it's high school mathematics. There's nothing fancy, nothing really complicated. Simplicity works, and now let's make some money. So thanks again for watching. Subscribe, give your like, and see you next time. Take care. Bye bye.